Last week, gold shocked a lot of traders and investors. Instead of acting like a classic safe haven, it dropped hard and fast. In this video, I'm going to break down exactly what happened, why gold fell, and what it could mean going forward. Let's get into it. First, the move itself. Gold had one of its worst weeks in decades, dropping around 9 to 10% in just a few days. This came right after a massive rally, where gold had been printing new all-time highs, and everyone was extremely bullish. So the market was already crowded with long positions, and very sensitive to any change in the macro narrative. So why did gold go down, especially in a time of war, geopolitical tension, and inflation fears? There are a few key reasons: interest rate expectations, the US dollar, energy prices, and pure positioning. Reason number 1, interest rate expectations flipped. For months, the dominant story was that central banks, especially the US Federal Reserve, were going to start cutting interest rates soon. Lower rates are usually positive for gold, because gold doesn't pay interest. When cash and bonds yield less, holding gold becomes more attractive. But last week, that narrative changed. Rising energy prices and stronger inflation data made markets believe that interest rates might stay higher for longer, and that cuts would be delayed. When the market suddenly prices in higher for longer, it hits assets like gold that benefited from the idea of easy money and lower yields. So instead of money flowing into gold, a lot of capital rotated back into the dollar and into bonds. Reason number 2, a stronger US dollar. Gold is priced in US dollars globally. When the dollar strengthens, gold often comes under pressure because it becomes more expensive for the rest of the world to buy it. Last week, the dollar index pushed higher as investors looked for safety in cash and US government debt. That stronger dollar acted like a headwind, pushing gold prices lower even while risks in the world were rising. Reason number 3, energy prices and war risk. On the surface, war in the Middle East and threats around key oil routes should be bullish for gold. Oil spiked, inflation fears went up, and headlines were full of risk. But in the short term, this actually scared markets into expecting tighter, or at least not so easy monetary policy. Instead of saying, "There's a war, buy gold," big players said, "Inflation risk is back, central banks will stay hawkish, buy dollars and bonds." So safe haven demand got split, and gold did not get the clean bid that many people expected. Reason number 4, positioning, leverage, and profit taking. This is the technical side of the story. Gold had been on an incredible run before this drop. We're talking about a move from the mid-$2,000s to above $5,000 per ounce over roughly a year. That kind of rally attracts a lot of momentum traders, leveraged funds, and late buyers chasing the move. Once price started to pull back, stop losses began to trigger. Forced selling kicked in, margin calls came through, and what started as a normal correction quickly turned into a cascade of liquidation. A lot of this selling was not about fundamentals changing overnight. It was simply traders closing out profitable long positions and others being forced out as price broke key support levels. So to put it together in simple terms, gold didn't fall because the world suddenly became safer or because inflation risks disappeared. It fell because the market narrative switched to rates will stay high, the dollar strengthened, and a crowded long trade unwound violently. Now, what does this mean going forward? Number 1, big drops after parabolic rallies are normal. If you zoom out, gold is still much higher than it was a year ago. Sharp corrections often happen in strong bull markets as a way to shake out weak hands. Number 2, the core long-term drivers for gold haven't magically vanished. Governments are still running large deficits. Global debt is still growing. Geopolitical risk is still elevated. Central banks around the world are still holding and even accumulating gold as a reserve asset. Those are structural, long-term reasons why gold has been in a major uptrend. Number 3, in the short term, gold will continue to trade based on expectations around interest rates, inflation data, and dollar strength. Every Fed speech, every major CPI release, and every big move in the bond market can create volatility in gold. So if you're trading it, you have to respect that macro calendar. If you're an investor with a long-term horizon, this kind of pullback can be seen as part of the normal cycle. But if you're a short-term trader, last week was a reminder that gold can move like a high beta risk asset when positioning is crowded and leveraged. To recap, gold dropped last week because the market suddenly priced in higher for longer interest rates, the US dollar strengthened, oil-driven inflation fears shifted flows into cash and bonds, and an overcrowded long trade in gold got unwound. It wasn't about gold losing its safe haven status forever. It was about the short-term mechanics of how modern markets respond when narratives, rates, and positioning collide. If you found this breakdown helpful, make sure to like the video, subscribe, and drop a comment telling me whether you think this gold correction is a buying opportunity or the start of a bigger top. Thanks for watching, and I'll see you in the next one.